Welcome to this video recap of our latest War Room session. Today we are discussing Operation Last Drop and the state of market liquidity. We are breaking down why the market is struggling to hit new highs. It comes down to a lack of available dollars to support the dips. Our agenda tonight covers the liquidity drain, major capital raises, the leverage graveyard, and how we are adjusting our playbook. Part 1. The drain. We look at what happens when the liquidity pool runs dry. Our thesis is clear. This is a plumbing problem, not a headline issue. Market leadership is sputtering because the capital has run out. Buying the dip only works if there is cash to back it. That liquid mountain has been strip mined, leaving us with air pockets. As this chart illustrates, household cash reserves are currently at levels not seen since the dot-com bust. Don't let the money market numbers fool you. When you combine savings and funds, real liquidity is at historic lows. A liquidity drought manifests on the tape through failed highs in hardware and stalled sector rotations. Every new share sale or IPO must now compete for this significantly shrinking pool of capital. Part 2. Why we believe SpaceX marked the market peak. SpaceX pulled over $100 billion out of the market at the top, vacuuming liquidity from an already strained system. This capital suck includes equity raises and fresh debt, accompanied by optimistic valuations from underwriters. The projected external capital needs remain massive, year after year, well into the next decade. If debt markets cannot meet these needs, further dilution is likely. It is a structural drain on market resources. The venture capital behind SpaceX is now effectively frozen. Because the stock hasn't traded up, those lockup releases haven't triggered, preventing that cash from recycling back into the market. History shows that every cycle has a deal that rings the bell. SpaceX fits the pattern. A massive raise priced at peak euphoria, supported by unrealistic long-term targets. We call this the milk run, because the liquidity source was already dry, yet the squeezing continued. It's the largest raise in history, hitting the thinnest cash cushion since 2000. Consider the scale. $110 billion in equity and debt, pulled from a market with dot-com low reserves. It set the stage for a calendar crowded with similar pressures. The first-year forecast for free cash flow positivity is 2035. This long-term horizon is being underwritten by the same analysts promoting massive valuation targets. Part 3. The leverage graveyard. When greed takes over, the market sees the birth of 2x ETFs on single stocks, often signaling the end of a cycle. The launch of these leveraged products was a major warning sign. Retail investors were encouraged to double dip on the hype, adding layer upon layer of risk. The results were swift. We witnessed drawdowns of 50 to 60% in these leveraged products in under a month. This isn't a long-term bear market timeline. It happened in weeks. With no rescue liquidity available, the leverage only accelerated the inevitable decline. The lesson here is that leveraged ETFs serve as a gauge for liquidity rather than a viable trading strategy. They signal when the market is overextended. Seeing a 50% drop in a 2x product within 3 weeks highlights exactly how empty the buy-side tank has become. Part 4. The pile-on. As market liquidity drained, other major corporations followed the trend, further pressuring the available supply of capital. Google, for instance, increased its share sale from $75 billion to nearly $85 billion. They even used Berkshire Hathaway as an anchor to instill market confidence. However, that discount has already evaporated. The market is now dealing with the reality of ongoing share dumping through the end of the year. Amazon then followed with a $25 billion raise. Individually, these deals might be manageable, but in aggregate, they act as a massive drain on market fuel. Moving on to SK Hynix. A $28 billion ADR is pricing this Friday. It is another major liquidity demand landing on a sector that is already among the weakest in the AI trade. The cue behind it is telling. There is talk that Anthropic might be next, while others, like OpenAI, appear to be waiting until the market can actually absorb the supply. The stack of these mega raises is immense, totaling nearly $250 billion, all competing for the same rapidly shrinking pool of available cash. When we compare the massive supply hitting the tape from companies like SpaceX, Google, and Amazon against the current market demand, the math only resolves in one direction. We see a feedback loop. Weak stock performance leads to frozen lockups, which in turn prevents capital from recycling, leaving the market even more vulnerable. Ultimately, we are looking at roughly $248 billion in combined raises for 2026. This fire hose of supply is hitting a market already at historic lows. Part 5. The situation on the ground has changed rapidly. The previous ceasefire is dead, and the risks to global infrastructure have escalated. Tensions in the region have spiked, with reported strikes in the Strait of Hormuz and the effective end of the interim peace deal. Recent statements indicate that the U.S. may continue further strikes, and there is a real possibility that the blockade could resume, adding significant pressure to the markets. The revocation of the oil waiver is the critical story here. By threatening the supply flow through the strait again, the global equation has reversed overnight. This has triggered a squeeze in crude oil prices. Everyone was positioned short based on a glut thesis, leading to significant forced covering as prices climbed. It is important to note that a definitive military resolution may not be feasible. Deep sights are hard to hit, suggesting the outcome here will likely be delayed by negotiation. Rhetoric has shifted toward energy and infrastructure targets. Since the diplomatic track has stalled, we are seeing a posture of maximum pressure, which typically precedes a pivot. Our thesis, which we call TACO, anticipates a walkback. Given a history of prioritizing market stability, we expect a negotiated delay, rather than a total escalation. Ultimately, the right thesis is meeting the wrong wallet. This scare hit a market lacking the cash to buy the dip, meaning we should expect a grind rather than a quick recovery.
Crude oil saw a 7 to 8% move on an intraday short squeeze. After starting up 5%, the lack of a walkback caused further movement. The market had been pressing a glut thesis all month, but a waiver revocation quickly burned through those short positions. Moving into the next part of this video, we look at the tape. This section breaks down what the screens were actually saying while the headlines were screaming. In the hardware sector, AMD showed a double rejection at its critical line. As noted in this stylized chart, the stock lost its level early, rejected the retest twice, and trended straight down afterward. The market is currently seeing a broad red, described not as a panic red, but a drought red. With upcoming liquidity drains like the SK Hynix event and rising oil prices, the tape currently lacks the fuel typically needed for an afternoon recovery. We are facing a bond problem as the 10-year yield breaks a key level. Yields have popped past the 4.57 shelf, while labor participation continues to slide, creating an ugly setup. Yield breakouts and liquidity droughts do not mix well. While we often see breakouts over this shelf followed by a return, every day spent above this level adds pressure to equity valuations during a period of very limited cash. When it comes to the labor market, the unemployment rate can be misleading. Reports show net job losses over the last year, and the low unemployment rate is largely due to falling workforce participation rather than job growth. The labor cycle has flipped back to soft. After a period of softening at the end of last year followed by a 6-month rebound, the trend has shifted again. Current conditions suggest a need for discipline. Nearly 1 million workers have left the labor force in the last 12 months. This shrinking denominator is artificially keeping the unemployment rate low, masking the true state of the economy. In this next segment, we look at single names. We will analyze 3 different software stocks and the distinct signals coming from their leadership. Regarding ServiceNow, our verdict remains unchanged. After reviewing the latest earnings and filings, we see negative shifts in churn dynamics and defensive executive signaling. It remains a pass for us. Our deep dive into ServiceNow flags several concerns: unfavorable shifts in churn, defensive management commentary, and a valuation that leaves no room for error in a low liquidity market. For Palantir, we maintain a bullish but patient outlook. We view the $89 mark as a significant technical level and a buying opportunity, with a year-end fair value target of approximately $190. This map illustrates our levels for Palantir. The purple line represents our primary buy zone, while the current price action is trending toward that support level. Patience is key here. Ironically, the current market chaos is benefiting Palantir. Geopolitical tensions strengthen the fundamental demand for their products within government and military alliances, potentially providing us with a strong entry point during this liquidity drought. Salesforce provides a different signal altogether. We have conducted 3 weeks of research, and the findings offer a very clear indicator for our outlook. In the 3 months ending April 30th, Salesforce took a significant step by issuing $24.8 billion in debt. They then used these funds to buy back $27.2 billion of their own stock, essentially borrowing to buy their own dip. This chart visualizes that move, borrowing $24.8 billion while repurchasing $27.2 billion in shares. Management is putting the balance sheet where its mouth is, which is a bullish signal. Comparing ServiceNow to Salesforce, we see a clear divergence. ServiceNow shows churn issues and defensive posturing, while Salesforce shows stable churn, expanding margins, and active buybacks. Our playbook remains consistent. We stay cautious and bearish in the short term, but we are actively looking to buy the drought for the long term. We are watching for a specific sequence for the market to regain its cash. This includes SK Hynix finishing its scheduled issuance, hardware prices finding a floor, and the 10-year yield pulling back. Once these conditions are met, we expect stabilization in hardware and a leadership rotation into healthcare and software. That is when we will begin buying dips with full size. Our rules for navigating this period are simple. Stay cash heavy with zero debt, remain cautious in the short term, and ladder your long-term entries rather than going in all at once. Drought discipline is the key to surviving this market. By planning your levels and waiting for the tag, you can avoid the mistakes of the impatient and the over-leveraged. This concludes our debrief on Operation Last Drop. We look forward to continuing the work in the war room. Please remember that none of this is financial advice.